I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk to you. Interesting summer we've been having, that's for sure, in the financial markets. We've been rallying all year, but things are slowing down a little bit. The VIX has fallen below 10, which measures the volatility in the markets, and it's actually this year been trading at a low level for this amount of time in its entire history. So the reason for that is because we've only had 2 days in which the S&P 500 was down more than 2%, and 2 other days when it was up more than 2%, which is a real oddity in stock market history.
Well, we've had an equity market extend now for a record period of time, 9 years now?
Well, that's how long the bull market has been, but of course we have had a couple corrections during that time frame. It just seems like it hasn't happened because it's been so long ago, but between July of 2015 and January 2016, the NASDAQ fell roughly 18%. There was a correction in October of 2014, one in 2010, another one in 2011. But we haven't had one now for about almost 19 months. So people have kind of forgotten about that they can even happen, and are almost afraid that the market's going to go up without them. However, I think there are some signs that we could be heading for another correction this fall because there's some change in character of the market that is starting to appear. For example, we just have gone through earnings season the past couple of weeks. Today, Apple announced earnings, and it did gap up. There has been tremendous excitement over Apple today. However, the S&P 500 is not at a new high, even though the Dow is. The Russell 2000 got hit this morning. And interesting stat is during this quarterly earnings season, the average stock actually fell after it reported earnings the next day by over 0.7%. So the stocks have been selling earnings and not going up on earnings. And this is actually the first time that they've fallen that much after an earnings report since the summer of 2014. So that's about 2 years ago. So I think that's a sign that the rally is actually starting to get tired. The divergence between the Russell and the Dow, which the Dow is 30 stocks, the Russell is 1,000, is another example of that. However, this is just a warning sign, and I think, if I'm going to say, I think the stock market's going to drop this fall, most people listening will think, well, that's just a prediction. People make predictions all the time, and if I turn on CNBC or listen to the media or just about anyone else, they're going to be bullish. So why should I listen to this one person on your show making a prediction for a drop when nothing has been falling and everyone is bullish? Well, I want to say not to listen to my prediction or anyone else's prediction, but to look at the action in the market. And what would warn that correction is actually going to occur is if the S&P 500 and the NASDAQ were to go below their 50-day moving averages, as they've been acting as support all year long and really going into November, and go down to their 150 or 200-day moving averages. Right now, the 150 is at 2380 on the S&P 500. I would then expect the market to hold up or bounce, and if we went to that level whatever the low would be set, let's say in September, October, then you can expect this to turn into a correction in the fall. But right now, I'm not really expecting much to happen for the next few weeks, probably not until the next time we speak. But if we see the Russell 2000 continue to act weak, and by the way, the transportation average also is broken down, it's giving a Dow theory sell signal. If you go by Richard Russell's theories, he's passed away, but he was a big pioneer in Dow theory. So that's another warning sign. So I think there's some warning signs out there, but they need to be confirmed with the market averages going through support, which is the 50-day moving average and down to the long-term moving averages. If that were to occur with internal deterioration in the market, the percentage of stocks performing with the S&P, if that were to go down, meaning that money stocks start to all of a sudden lag, that would also be a warning sign. So I think we have to keep our eyes peeled open to the internal characteristics of the market, and if they weaken over the next couple of weeks, we have to be prepared for a correction in September, October, November. And I personally think that it's good for people to, if they're fully invested in the stock market, to do some selling, raise some cash, move into alternative assets, whether that's bonds or gold or silver. And this is really a message for Americans because so many people have been flooding into the U.S. stock market in the United States this year, and they're fully invested. There's record margin debt levels that have been accumulated this summer. And both the CEOs of Ameritrade and Charles Schwab have come out with statements this quarter saying that they've seen a record number of small individual Americans in the United States opening up brokerage accounts this year to get involved in the market. In fact, the Schwab CEO said there have been more accounts opened up this year than since before 2008. Again, when you see the small fries chase stocks, go on margin, eventually you're heading for trouble. Not tomorrow, maybe not next week, but I do think before this year's over that a lot of people are going to be forced to get off margin, and that will create some rocky moves in the markets. And I assume to say, look, let's just get out of that ahead of time, take some selling, go on vacation, and and let that sort of thing play out.
Yeah, I thought the scenario was supposed to be sell in May and go away.
Well, that's something that's happened too. That is a saying that people have. It's a popular saying because historically that has been true. That June, July, August, September and October have been the worst months of the market. But I think it's noteworthy to say that if you look at what happened since May, the market broke out. Well, first of all, it went a little higher for a week in June, topped out, came back down, and then it broke out in July, and really went nowhere. The Nasdaq, for instance, hit 63.13 this morning. It was at 63.13 exactly 6 weeks ago. The Dow has gone above the 21,000 level. Today, it's managed to close, or as we're speaking at least, it's at 22,000. But that's not even a move of 10%. It's just about an 800 point advance over 6 weeks. So it's not like there's massive gains going on, but that reality that the market has not fallen since May is emboldening people to think that, well, that might mean it's going to go up all year, or that corrections aren't very likely. And unfortunately, in the end, way too many people end up responding only to price movement. So they get fully invested, and then they only get out when they're down 15 or 20%, and then things turn around and start going back up. And the only way to escape that type of cycle, and everyone has done it one time or another, so you got to learn from your mistakes, but the only way to escape it is to be willing to take some money off the table when there is a rally, and accept the fact that you're not going to be able to get out at the top. And not being able to get out at the top is a small price to pay to have to ride something out at some point for 20% losses. So that's the message I got for people fully invested in the stock market. And I think, even though, as you said, the Dow went up, the market's up for May, gold stocks outperformed the market last year. The GDX went up 50%, even though it had a correction from July to December, and it's been going sideways all year. GDX is the gold stock ETF. I'm in a position in it, but it's in a position where it can break out. If it goes through 23, closes above 23, I think it's just going to go up and start outperforming the market and do very well going into the rest of the year. So it's sitting on its long-term 200 and 150-day moving averages after consolidating all year, and I can't predict if it's going to go above 23 tomorrow or next week or next month, but it's knowing what the setup is that's so important. And I think gold is in a bullish position. One reason why is because if you look at the Commitment of Traders report, the commercials who tend to be correct and usually almost always short the market because they hedge their positions, they reduced their net short position the other week to a point lower than where they were at in the first quarter of 2016, right before gold and gold stocks took off and the GDX more than doubled. So they got a smaller net short position they had then, and over the past couple weeks we've seen a little bit of a rally in gold from about 1,200 to 1,260, and during that rally, in the same Commitment of Traders reports during this past couple of weeks, the small speculator, the small individual trader, has not increased his net long position at all, and in fact, during one of these weeks, he tried to short 5,000 contracts. So if you look at the contrarian standpoint, everyone's bullish on the stock market. No one can believe there's going to be a pullback at all, it seems. People are on margin. People are going crazy to open up brokerage accounts. And there's some signs that things are changing with stocks actually falling on earnings, which suggests a change in character of the market. At the same time, no one cares about gold. Small people don't want to buy the rally. They even try to short the rally. So I think that's bottom line, simple message. Get out of the stock market if you're fully invested. At least do some selling and buy gold and gold stocks. That's the contrarian play. That's what I'm doing with my own money. And I think that's going to result in a investment position that from here to the end of the year will outperform the market in most hedge funds. And that's one other thing probably worth adding as part of what's going on in the stock market is there's been a complete and total mania this year of people throwing money into exchange-traded funds. Because the exchange-traded funds have actually outperformed mutual funds and hedge funds. The average hedge fund is only up 5.9% this year. It's underperformed the market. So we've actually reached a historical moment a couple months ago where there's more money in ETFs and more money that's flown into ETFs this year than hedge funds. So people are fleeing managed money with the notion that we don't even need to manage our money or even look at it. Just put our money in the ETF and shut our eyes. So we're essentially in a situation where people believe that investing no longer requires work, it no longer requires thinking. You can essentially treat your investment account as if you have a car and you sit in it and crank it, shut your eyes, and put your foot on the pedal, even ram your foot on the pedal if you're one of the people that wants to go on margin, and just do that. And if you do that, it can be exciting for a while until you hit a road or a roadblock or a speed bump or something, and then you're going to hit a very frightening situation. And this is essentially a metaphor I'm using for what the individual investor, the small fry in the United States, is doing with their money. And in the end, when you have everyone thinking we don't need to manage our accounts, we don't need money managers, professionals, we can just trust the ETF to go up forever, that type of psychology will shift. It might take a year or two or three, but people will eventually want to return to the professional money managers. I saw this same sort of cycle play out 10 years ago before the crash of 2008. There was a moment in which hedge funds were lagging the market for a year or two, and people started to flee them. And then after 2008, for a couple of years, there was a flood of money going into hedge funds. So that's part of the big investment cycle too. So we're kind of in an interesting moment. In some ways, it's a strange moment because while the stock market has super low volatility and has so far floated up all year, although now we're starting to see some internal cracks, but that is the reality. It has floated up all year, kind of very calmly. Not once has there been a move to scare people. But despite that, if you turn on your TV set tonight and watch your Fox News or MSNBC or CNN, you will see crazy stories, crazy headlines. Back in November, December, there was a promise of economic growth that was to come. We were going to get 4 interest rate hikes. We've only gotten 2 in June, or just the other week, in July, just 2 weeks ago when the Fed met. Janet Yellen did not raise interest rates, so now we're only going to get at most 1 more rate hike in December. Probably not. The market has only like a 45% chance it's going to happen. Any dip, it won't. Point is, going into this year, we had these expectations of high economic growth, 4 interest rate hikes that would be prompted, fueled with tax cuts and government spending stimulus. None of this is materialized. The healthcare bill's gone. Tax cuts. Now, the official line this morning is possibly November, but just last month they were saying possibly August. And if they do come, they won't be anything of the size that it appeared they could have been. So all the things that were used in December to justify the rally have not materialized. There's no economic boom. Inflation data is weak, yet the stock market does not care. Now, if you historically go back and look at other years in which the economy did not match the expectations that investors had coming into the year, typically you end up with a correction in the fall. August tends to be a funny month because a lot of people go on vacation, the volume vanishes, and you're kind of far enough out from the third and the fourth and final earnings season that people don't think about it. But once you get to like September, October, people start to think about, is the second half economic growth going to really be as good as we thought? If not, the bottom line of companies will be impacted and they start to sell. So I think that's a sort of situation we're going to get into when Labor Day comes. I know people in the ETFs, they're not going to think like that. They're not going to think about earnings or holdings or anything like that. They just hold the ETF. But professional money managers that still manage the bulk of the money in the stock market, they will be looking to see if company earnings in the next round of earnings reports is going to match the expectations set earlier this year. Will the economic growth materialize that was predicted? So far, it has not at all. So we're going to have a very interesting fall. And again, the lack of volatility and the calmness in the stock market does not match the news in Washington. And at some point, I think one of 2 things will happen. Either Washington will get better, things will calm down there, and we'll get all these programs will materialize, and Trump's poll numbers will start to go up, and there will be a new dawn of Washington, D.C., where all our lives are fixed and America is, in fact, made great again. Or that won't happen, and the stock market will match the so much chaos, so far what's been chaos in D.C. So is D.C. going to get better, or is the stock market going to become chaotic? One of the 2 is going to happen, and I think we're going to reach the point where we'll see that start to happen by September, October.
We'll have more with Mike Swanson right after the break.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Mike Swanson. Mike, I just heard a trader say on television the other day, the White House is so chaotic. There's no way that you can plan to do your trading on anything you expect out of there. You have to look at reality and what's happening for real, not what's happening on Twitter.
Well, I think that's absolutely correct. And a reason for that is if you look at some of the pronouncements on Twitter, they don't ever materialize. I mean, just last week, Trump said something to the effect that they're going to eliminate these transgender people out of the military and make them quit and never hire any more of these people. And he tweeted this, and it created this huge controversy. Of course, some people get angry about it, and then his supporters get angry at the people getting angry, and it becomes a focus on what's he going to say next. And then all of a sudden, the generals come out and they say, well, we never got a real directive from the White House about that, and it's not happening until we get one. And there's been multiple occasions where Trump tweets something that creates controversy, but there's actually no actual orders or directives being given about what he's tweeting about. And I think it's almost like a show. So I don't really pay much attention to what he's saying on Twitter. And again, so far, it hasn't actually mattered to the stock market what he's doing, not doing, or what Congress is doing or not doing. And that's one argument I've heard bulls make on television on CNBC. They say, well, nothing matters anymore except the stock market going up. And these are the same people that said that Trump was going to do things and that the economy would explode. They don't even talk about the economy anymore. They just say the stock market's going up. It's going up. It's going up. You can't miss it, basically. And I don't know when the last time I heard that was, but in the end, it's not going to go on forever like that. But I just think that in reality, when you're in a bull market, the news actually doesn't seem to make any difference whether it's good or bad news. The market uses any news to go up. So you think last year when Brexit hit, the market got down and then went up. Going into the Trump election, so many of these commentators on CNBC and then the other news networks were predicting the stock market would drop if Trump won because they don't like Trump and they're trying to scare people from voting for him. And, of course, he won and the market went up. The point is the news doesn't actually matter, and it doesn't matter until the market tops out and the trend is down. Then all the news becomes bad or a reason to sell. So what I'm saying is it's the market trend that matters. And we're in this bull market, as you said, started in 2009, so we're 8 years into it. But not only that, but we're in a rally that has gone on without a pullback. And there hasn't been a market correction in a long time since the last one bottomed out over a year ago in January 2016. So there hasn't been any pullback of any meaningful amount for so long that every day from now on that goes on, it becomes more and more risky to be fully invested or a margin. You know, the average person has to get themselves ready for a pullback. You can't just say this market's never going to pull back and I'm just going to not ever concern myself with one and just be fully invested and on margin, because there's so many people on margin now. It's just absolutely amazing. So I'm just trying to sound a note of caution. Whether that will do much good, I don't know. But hopefully it does.
We'll have more with Mike Swanson right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Mike Swanson. Mike, what's your outlook for oil? It seems to me it's done surprisingly well.
Well, the oil stocks themselves are actually the worst performing sector of the year. If you look at the XLE ETF, now over the past few weeks, though, they've been going sideways and trying to form something of a bottom. Seasonally, oil tends to rally in the summer and top out in July and drop into December, January. And this year, a few months ago, inside the futures market, the commercials have put on the biggest short position in their entire history. So I'm not bullish on oil, and I prefer, I want to invest in oil stocks, but I prefer to wait, see what happens over the next couple months and look for another dip in them. We've come back up in the oil market for sure since the low made back in June. We're about $50 a barrel now. But let's see if we can hold that and see what happens. I'm sort of skeptical. Really, I know people want to hear of kind of being a party pooper, telling people sell this or wait for that. But in the end, the thing I think people really should be buying is gold, silver, and mining stocks. Look, you can buy an ounce of gold right now for $1,260, and $1,200 an ounce. That's pretty much a solid floor on it because of the amount of the lack of long positions in the commercials market by the small speculator. I really don't see gold making a crash. The hedge funds, which are the large speculators, you look at the Commitment of Traders report, they also greatly reduced their holdings to equivalent of where they were in 2016 before gold went up. So we don't have many people invested in the gold market, and the commercials have a very small short position. And forget about predicting it's going to rally or go to 10,000 or this and that. One of the most important implications of it is that there just isn't that much huge downside. I really think this is a good place to buy, and the downside risk is about $1,200 an ounce if it were to even drop at all. And you're talking about something then that's got a downside risk of not 10%, but 4.8%. That's not very much. I like to put my money, if I'm going to invest in something with little downside risk. And it doesn't, the amount it costs to produce an ounce of gold is around $1,100 an ounce. Well, that's the downside risk. That, to me, makes for a good investment. Compare that to Facebook or Amazon. What's the downside risk? Fundamentally, what are these stocks actually worth? They got crazy PEs. Well, if you think about something, and everyone knows that, even on CNBC they say these stocks have high valuations. Well, let's talk about something that seems more safe. Bank stocks. They pay bigger dividends than those tech stocks, but they got PEs over 20. So there's downside risk. It doesn't mean they can't go up, but from an investment standpoint, it just doesn't make much sense to me. Where if you get gold and silver, you got very limited downside.
And Mike, before we go, the head of Shell Oil has said his next car is going to be electric. He's getting rid of his diesel. What does that tell us about the long-term future of petro-powered vehicles?
Well, I actually have an electric car, but myself, but I don't. It's kind of funny, you know. Back in 2007, you'd see articles about peak oil, which would imply that oil is just going to go up forever. And now you see stuff that suggests complete and total opposite. And I've seen articles that suggest oil is not the future, that it's just going to get worthless. And I think that's a sign that we're in an oil bear market, and that started actually in 2014, and we're 3 years into one where people are actually starting to get despondent and so bearish that they're just giving up forever. And I think that's actually a positive sign for the long term. Again, compare that sort of psychology to where we are with the stock market. You don't hear anyone saying stocks are a terrible investment, but oil and other commodities, they are saying that about. So I don't, you know, for the long, I myself, I'm, you know, somewhat negative on oil, but I don't think it's going to not ever be a good investment again or go up again. That's a little too much for me.
Mike, thank you so much for chatting with us.
Yeah, thank you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.